everyone. A very good evening. Thanks so much for tuning in. This is the Money Show, the daily show that's one of its kind that brings you the top market financial experts in order to answer all your financial queries. I'm Avan Dabash and with me is Apni Raja. Hi, Apni.
Hi, Avan. Well, let's get to our guest today who's joining us on the show. Harsh Roongta, personal finance expert, is here with us to answer all of your financial queries. But Harsh, thanks so much for joining us on the show today. Great having you. The first question, before we get to all the queries that we've been getting, the first important question that I want to ask you about is about life insurance, because this is often a very concept that often is lost on a lot of people on who really needs life insurance and whether non-earning family members actually need to opt for a life cover itself. If you can just elaborate a little bit on that and explain to our viewers as to why non-earning members don't really need life insurance.
See, the basic concept of life insurance is that in the case of the death of the earning member, the earnings stop with him. And therefore, when you get a corpus, a big amount from the life insurance policy, that amount can be used to generate the income that has stopped because of the death of the earner. Now, obviously, if the person is not earning anything, then there will not be the need for a life insurance. There is no need to replace the earning. You frequently see missales happening in respect of lives of housewife or lives of children. Now, at least as far as say non-earning spouses are concerned, the issue is that at least there is an increase in expenditure because of the death of, say, a non-earning spouse. And maybe that is something a small insurance cover maybe is needed. But again, more than that, it will not be possible to get as well. But having a life insurance cover on your child's life is literally trying to benefit from the child's death. I mean, forget about it not being needed. It's in very, very bad taste.
Okay, so absolutely no need for a non-earning member for life insurance, and in fact Harsh spoke about how it would perhaps be in bad taste. A smaller small life cover for a non-earning spouse would be the order of the day. So that's life insurance and its implications for a non-earning member. Now, Harsh, we've got a load of queries for you, so let's get straight to that. Well, in fact, this is an email query which has been sent in to us from Proj. He says that the last time Mr. Roongta had advised the dynamic equity balanced advantage and equity savings funds. Can you explain what are the subtle or the major differences between these categories of funds? And I'm sure there are a lot of people who are in the same boat who just want to understand some of the distinguishing features of each of these funds and what is it that differentiates them: equity, balanced advantage and equity savings funds. If you could just give us a detailed synopsis on this, since Proj has directed this query to you.
Okay, so I think very interesting question. First of all the three categories are classified as equity funds for the purpose of taxation. That is one. But inherently within these funds, the breakup between equity and debt is maintained based on a pre-decided formula. That formula would be different for different funds. It could be based on price to book value ratios. It could be based on price to earning ratios. It could be based on yield gap or a specified kind of a formula. The point is, it takes emotions out of the proportion between debt and equity. That is decided as per a formula. And obviously, then which equity to take within the equity proportion, what debt to take between that debt proportion, that is decided by the respective debt and equity fund managers. But the proportion itself is decided by a formula and therefore takes the emotions out. Now, what are these three categories? I think what it does is that all the three, whether it is dynamic equity, balanced advantage or equity saving, from the debt portion, a certain part is kept in equity arbitrage, which is treated as equity but which gives debt-like returns. And therefore, the tax treatment of all the three types of funds is as an equity fund. Now, in an equity dynamic fund, for example, if we take the example as on September 30th, and let's pick up a fund house which has all the three. So, if you pick up ICICI Prudential, its dynamic equity fund is called ICICI Prudential Dynamic Equity Fund. As on September 30th, the dynamic equity fund had a equity proportion of 65%. As on same date, the balanced advantage had an equity proportion of 46%. And as on the same date, the equity savings had a proportion of 25%. So, in the idea is that dynamic equity is meant for an aggressive investor, balanced advantage is for a moderately aggressive investor, and equity savings fund would be meant for a moderate investor. The difference is that otherwise the basic characteristic is similar.
Harsh, just to take that forward in terms from a returns perspective, how much of a difference are we talking about here?
So it obviously, I mean, in the current market, you will obviously find dynamic equity would do better than balanced advantage would do better than equity savings fund, simply because equity has run up a lot. When the markets are falling, you might probably see a reverse of this, because then debt would do well, and therefore equity savings would score over balanced advantage would score over dynamic equity. Just think of this as a dynamic equity as a equity fund, balanced advantage as a balanced fund, and a equity saving as the good old MIP fund. And I think the returns would be more or less be matching with that,
Right.
except that the
Well,
treatment is of an equity fund.
all right, got it. So, hope, Praj, you've got what the answer that you were looking for and understood the differences between the various categories like you had asked. Harsh, let's move on to the next query. It's coming in from Karthik, who sent in an email saying, I'm currently investing 5,000 rupees per month via SIP in 4 different mutual funds for my children's marriage and overseas education. I plan to invest another 5,000 rupees per month for the long term. Am I on the right track? Please advise. Now, as far as his portfolio is concerned, he's got HDFC Equity, HDFC Mid and Small Cap, IDFC Premier Equity, and Birla Sun Life Growth Fund. So, Harsh, what would be? He's quite clear in terms of what his goals are and what he wants to save and invest for. What would be your advice to him given his current mutual fund portfolio?
No, so first of all, I think even on the goals, I don't know if he has done the working. We don't have any idea what his goals are and when he needs it, and whether the money that he is investing is going to be enough for whatever his goals are. As far as the funds themselves are concerned, I think like a lot of other investors, all the 4 funds are, I mean, 3 funds we know. HDFC Equity is a multi-cap fund. HDFC Small and Mid Cap, which is now been renamed as HDFC Small Cap, is a small cap fund. And IDFC Premier Equity is a mid cap fund. All the 3 funds are well regarded. The 4th one, I think, is not given the name correctly. The point is, these are probably picked up from these are all well regarded funds, well rated funds, and probably picked up from ratings available on a lot of sites. Now there is too much over diversification. He is investing 5,000 rupees a month. He has got 4 schemes already. He wants to invest another 5,000 rupees, and he's asking whether or not to put it in other schemes. So first of all, the issue with over diversification is, what investors think is that by putting in a bit here, a bit there, a bit there, I sort of hedge my risks. But what happens in this hedging is, what investors forget is that roughly in India about 300 scrips totally make up about 94% of the market cap. You buy 3-4 schemes and you will end up literally owning the market, but at a high cost. One of the schemes will do well, one of the schemes will do middlingly, other schemes will not do so well. Eventually, you will get probably somewhere around index returns, but at a higher cost. You'll be plus you will find it very difficult to track so many schemes. So I think you must consolidate. As far as Karthik is concerned, at least the good thing he has done is that at least he is diversified across multi-cap, mid-cap and small cap. So at least the duplication is not too much. Please don't diversify further. I think the existing schemes are good. Whatever is your 5,000 rupees, please put him in one of these three schemes. I would say put it in a multi-cap. I would have advised a large cap, but I don't want to add another scheme to him. So the multi-cap that he has, which is a HDFC equity, he can perhaps add it to that. And please do a proper goal mapping. I think that would be far more important work to do than choosing a specific scheme. I think far too much importance is given to the scheme choosing when a lot more importance should be given to the breakup between equity and debt. We have not even spoken about debt. I assume he's got some debt which he is using to balance the equity investments that he has.
Okay, that's the view coming in, and I hope, Karthik, you took note of the advice. So at least Harsh said that you have looked at a little bit of diversification, but it's very important that you have an appropriate index fund in your portfolio. Over diversification will make it a little difficult as well to track. Let's move on then to our next query for the day. This one has been sent in to us via email on the Money Show at etnow.tv, where we encourage you to send in all your questions. So the email to us by Parag. Parag says that the ULIP policy for my wife is going to mature in a few months. I have been paying the premium for the policy since my wife was a housewife for the most part. The maturity amount will be deposited in her bank account. I would like to know, if we keep the money in savings account or a fixed deposit, will the interest amount be added to my income? Can you please clarify the tax treatment for the interest or the short-term gain arising out of the maturity amount being invested in the fixed deposit or in the savings account? It gets a little bit technical. What is the kind of rules and when it comes to the ULIP policy and the taxes and gains on maturity, Harsh?
So very, very interesting question actually raised by Parag. First of all, I am assuming that the maturity amount or the sum assured on the policy was 5 or 10 times depending on when he took the policy, and therefore the maturity value is exempt. At least that's a basic assumption. Then there are clubbing provisions. So if a person gives a gift to the spouse, then any income arising out of that gift is taxed back in the hands of the person who gave the gift. It can be either ways. It can be husband gifting to wife or wife gifting to husband. It is a moot point whether premium paid on the life of your wife is a gift at all. I'm not going, that's a really technical question. I'm not going into that. I am assuming it is a gift. So that's an assumption which is not necessarily true. If it is a gift, now suppose the premium on this, it is, let us say the premium that he had paid was 2 lakhs and the maturity value was say 3.5 lakhs. And the entire 3.5 lakhs is now invested in a bank fixed deposits. Now, income on income is not to be clubbed, which means that out of the 3.5 lakhs maturity proceeds, only 2 lakhs is the original gift. 1.5 lakhs is the income which was not taxable in any case because the maturity proceed was not taxable. Now the interest arising on 3.5, only 2 divided by 3.5 will be taxed or will be clubbed in the hands of the husband, and 1.5 upon 3.5 will not be clubbed. At least that part is absolutely clear.
All right, Parag, hope that's clarified for you as far as what the tax treatment is going to be with regards to the amount that you get now from your wife's ULIP. But on that note, time for a quick break. But please do send in all your personal finance related queries, and just a reminder, no stock queries, but anything else with regards to mutual funds, insurance, personal finance, do call in on 24837111. You can email us, themoneyshow@etnow.tv. Send us your questions either on Facebook or even on Twitter, or log on to invol.in and hashtag The Money Show. Welcome back. You're watching The Money Show, and we have with us Harsh Roongta, personal finance expert, who's joined us and answering all of your queries. Harsh, before we get to the next set of questions that we have, I want to talk to you about another very important topic that you were also discussing a while back, which is the problems that over-diversification in your portfolio can really create. And this is something that a lot of people don't realize, because we tend to forget that a single mutual fund already offers us a whole host of diversification and a whole host of companies in your portfolio, and then we end up buying several more funds and completely over-diversify unnecessarily. So what should one really keep in mind, and how should one go about planning one's portfolio without over-diversifying really?
So, as you rightly mentioned, one scheme would have 30, 50, some of the larger schemes have more scripts anyway. So, there is diversification there itself. And if you buy more number of schemes, all that will happen is you end up buying the market. Now, this comes at a cost, whereas the return invariably will be the average market return. So, if instead of doing that, if you want to really diversify, then just buy the index, because at least you will get it cheaper than a regular active fund. I'm not recommending an index, but effectively by over diversifying, you are actually buying an index. That is one. Plus, you can't keep track of too many schemes. I mean, schemes, the performances, etc., change. And I think the whole focus on schemes comes from this focus on backing the best horse, backing the best winner. But winners change from year to year. If you are betting on runners running in a marathon, your marathon is going to end. If you're saving up or investing for your retirement, the money is needed 15 years later. There is clear data to show that if you keep switching your money from one scheme to the another, depending on how it behaved last year, you will end up with less at the end of 10-15 years than if you had stuck to a reasonably well performing scheme, even though in later years it might have dropped from the top position from the first quartile to the second quartile. I think as long as you stick to schemes within the first two quartiles, you're reasonably well. Consistency is far more important than over diversification.
Okay, that's the advice coming in. I hope you've taken note on the balancing act and not really over diversifying, because instead of buying several funds, Harsh believes that it is better to buy into index funds, because otherwise you will find it very difficult to keep track. So pruning your portfolio also over and over would be a prudent strategy to adopt. Well, we've got a caller who connected with us whilst watching the show right now, Yash Gandhi. Sorry, I'm sorry about that. That's Mr. S. Roopchand, who is calling in from Mumbai with a question. Thank you for joining in on the show. Tell us your question.
I'm a retiree. I wanted to invest a lump sum in this Tata Retirement Savings Scheme Moderate Plan as a lump sum. Is it advisable?
Okay, let's get in the view then from Harsh. And how would you look at this fund as a whole? Give us your sort of a rating, because it has about 261 crores assets as on the 30th of September 2017. In terms of the growth that it's seen in the last 1 year, it has been about 34%. What would be your advice on a year-to-date basis? That's how the fund has grown. Is it a prudent fund to have, Mr. Roopchand asks?
I mean, he's a retiree, but I'm assuming that his risk, even a retiree, today people live well into their 90s or definitely well into their late 80s. And if you are just 60 or 61, please remember you are planning for your next 25 years. So that's a pretty long time. And therefore, even for retirees, a certain percentage to equity is really called for. Uh, what that percentage should be will depend on what is your current age and obviously your ability to take risk. I think Tata Retirement Saving Fund moderate plan that he mentions is an equity oriented hybrid plan. I think it would fall somewhere between equity saving and a balanced advantage plan in terms of equity percentage. And I think as long as he is looking at it for the long term, it's a good plan. Only issue with these plans, I think some of them have been sold based on dividend declaration. Please do not buy these plans based on dividend declaration. Dividend in a mutual fund is your own money coming back to you. Your NAV goes down by exactly that much. And dividends are not guaranteed. I mean, all that it requires is the market to have a downtrend before the dividends will stop. So if you have bought it for dividends, then think again. If you have bought it for the long term, it is an excellent plan. It's a well rated plan. It's a small enough plan so that it has scope to expand. I think it's a good plan provided you have a moderately aggressive risk profile and a long period over which you will use these funds.
All right, Mr. Roopchand, I hope you've got the answer that you were looking for and you've understood what Mr. Roongta is saying. Thank you so much for calling us. We encourage you also to call and send in your queries and we'll get them answered right here on The Money Show. But Harsh, going across to our next question from Yash Gandhi, who sent us an email and asks, can one start investing in SIP for the next 3 years in Reliance Pharma Fund? Please advise. Harsh, he has a very specific fund that he wants to invest in, which is the Reliance Pharma Fund. While you're answering his question, if you could also take into account the fact that it's the way one should approach whether it's sectoral funds, whether it's thematic funds, because again, these categories of funds are not really for everyone unless you have a deep knowledge of that particular sector or theme that you're talking about.
Absolutely. But even before I answer that, let me take up this issue about 3-year SIP funds. I mean, 3-year SIP. If your investment horizon itself is 3 years, then even if you are aggressive, please do not put money in an equity fund. If you want your money back after 3 years, even a SIP will have great difficulty in sort of tempering the risk. You need a much longer runway for tempering the risk. You need at least a 7-8 year period before you can consider a pure equity fund. For a 3-year period, I would say, even if you are an aggressive investor, only if you are an aggressive investor, please use a equity saving fund, if at all you are an aggressive investor. Now coming to the point about sectoral or thematic kind of funds, as you rightly said, unless you have a definite knowledge about the sector, a deep knowledge about the sector, why would you buy a sectoral fund? I mean, you buy any multi-cap or any cap fund, invariably it will have an allocation to pharma. That allocation to pharma might range anywhere in single-digit percentages to slightly double-digit percentages, but you will get an allocation to pharma. So unless you have a reason to take a specific exposure, and if you have that reason and if you have that knowledge, then why not invest in the company directly? Then why invest in a fund? If you have enough of a knowledge, invest in the specific company that you have knowledge of.
Okay, I hope you've taken note. Reliance Pharma Fund, perhaps not good enough according to Harsh. On that note, Harsh, thank you so much for joining in and giving us your expert advice. I want to just tell all of the viewers, we are getting all of your questions. We aren't able to address them today, but we promise to take them up over the course of this week. So do stay tuned to The Money Show and keep the queries coming. Thanks for watching.